Welcome to the Pursuing Points podcast, where it's all about the pursuit of credit card points and miles today so that you can travel the world free of charge tomorrow. And now, your host, Peter Foti.
Hello, everyone. Welcome to the 31st taping of the Pursuing Points podcast. My name is Peter, and today we are going to talk about your credit score and how it might be in for a change. But before we get into that, we need to take a step back about 6 years or so into the past and talk a little bit about what was happening with credit scores after the recession. So, as I'm sure everyone knows, back in 2008, we had one of, if not the worst, financial crises in American history. If you're not super familiar and you would like to be, the book, The Big Short, and also the movie do an excellent job of sort of explaining what had happened. But effectively, a lot of people were incredibly over-leveraged and investing their money into these, they called them synthetic CDOs or collateralized debt obligations. These were all based on housing prices effectively continuing to rise in perpetuity. That assumption proved to be faulty, and when the bottom fell out, all kinds of people lost all kinds of money. And because of this, big banks, they were some of the ones who were most negatively affected. They lost billions and billions of dollars. And as a result, the banks became extremely risk averse and extremely conservative in the years following that crisis. And effectively what they did is they decided that they were only going to lend money to those borrowers who they considered to be the most creditworthy. Okay. And specifically, they, in the Wall Street Journal back in August of 2014, they wrote, since the recession, many lenders have approved only the best borrowers, usually those with few or no blemishes on their credit report. Right? Because the reality is the banks could not afford to take any more of the risks that they had previously been taking in the wake of this crisis. Because if they did and they continued to lose even more money, they would have gone out of business. At least in theory. Of course, the whole too big to fail thing, that's a topic for a separate podcast entirely. But the bottom line is they didn't want to lend you money unless they were as sure as they could have possibly been that you were going to pay them back. But the reality is banks make money by lending. Right? So when you swipe your credit card, if you take out a mortgage, a car loan, whatever it might be, banks make money by lending. And so after 6 years of this extremely conservative approach, in 2014, the banks went to Fair Isaac Corporation, or FICO, as it's more commonly known, and they said, you know what, we need you to change the way that you calculate credit scores, because we want to lend money to more people. Okay? Because again, a lot of people, as a result of the recession, maybe they had a house that went underwater, they went delinquent on some of their payments, any number of things could have happened. And these were the people who were unable to get loans during this 6-year period. So they went to FICO and they said, we need you guys to modify the scoring system such that more people can get loans from us effectively. And what FICO decided to do is they made two significant changes. The first change was they would wipe away they would wipe away any blemish for a bill which was in a collection agency but had then since been paid off. So prior to this change, if you had a bill go to a collection agency, that would serve as a blemish on your report in perpetuity. Whereas now, even if you went to a collection agency, as long as you paid off that bill in full, they would erase that mark. And then the other thing that they did is that they lessened the severity of having unpaid medical bills that went to a collection agency. And these two changes had a profound impact. People's scores started to increase. Banks became more likely to lend money. And obviously now for the last 10 years, thereabouts, we've been in the sort of the greatest bull market of all time. But there are downsides to these things as well. And I think you're starting to see some of these downsides occur. And as a result, FICO is once again being asked to make some changes. So not too long ago, Discover Financial Services, that is, released their quarterly earnings. This is back in the end of January. And their stock fell 11%. Now, this podcast isn't about stock trading, but this is sort of ancillary related to the primary topic, which was changes in FICO scores. Discover reported their earnings, and their stock fell by 11%. Why did that happen? That happened because on their earnings call, they announced that they had over $3 billion worth of what they called troubled debt restructurings. And so what this number effectively is this is $3.4 billion worth of credit card debt that Discover is having trouble recouping. So it's gone to the customer, and they've restructured the payment plan such that perhaps they lowered the interest rate or they extended the payment term or whatever, right? In some way, shape, or form, they restructured it, and now they're trying to get it back. But this $3.4 billion is up from $1.4 billion in the prior year. So just think about that. In 1 year, they've tripled the amount of troubled debt restructurings. And I don't think that this is a good thing. In fact, obviously, the stock fell by 11%. Analysts and the Wall Street Journal pretty much summarily said that, this is not good. And what's interesting is that the banks now are reversing course. And they're asking FICO to now change the scoring algorithm yet again because they feel like they're giving money to people who maybe aren't as creditworthy as the score would lead them to believe. Which brings us to the new set of changes that FICO is going to be rolling out. Now, Discover isn't alone in this criticism. The CEO of Capital One on a recent earnings call said something similar. Effectively, what is the issue at play here is, let's say that you and I both have a 720 credit score. But one of us in our past was delinquent on a loan, right? Or something got charged off or what have you, right? Like, let's say that in the financial crisis, right, one of us lost our house. The Capital One CEO is basically of the mind that the person who lost their house, even though they now have the same score as this other person, is probably less creditworthy than the one who has a 720 but never lost their home. Now, whether that's agreeable for you or that's fair is largely, I think, a matter of opinion, and I'll let you form your own. If you'd like to share it with me, feel free. But the bottom line is the banks are not happy about the fact that they're loaning all this money to people who have these good scores, and then these people are not paying off the loans in time. One of the biggest credit card myths, I think, of all time is this idea that if you're someone like me or a lot of listeners of the show and you pay off your credit card every month, that somehow you're bad for the credit card companies because they want you to go into debt and then they want to charge you all these fees and blah, 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 blah. That's just not true, right? Every single time you swipe your credit card, the company makes money. And sure, if you have to pay a little bit of interest because you're late on a payment here and there, sure, they're going to make a little bit extra money. But I think what they're much more interested in is having you spend thousands of dollars a month and paying it off, as opposed to spending thousands of dollars a month and not being able to pay it off. Because sure, on paper, they're going to be able to charge you interest and late fees, etc. But in practice, they may or may not ever get that money from you, right? If you declare bankruptcy or if it goes into collections and they have to take 50 cents on the dollar, they would much prefer that you make your payments. And so they went to FICO and said, we need you guys to modify your algorithm such that scores for people who we believe aren't actually as creditworthy as you've led us to believe will start to decrease. So FICO, in the same way that, like Moody's was rating bonds back during the financial crisis, FICO is sort of at the mercy of these banks, because if they want to provide their service, because remember, FICO is not the only game in town, right? There are other companies who can provide a credit score. FICO is just the most well-known. So they're a business just like everybody else. So if their customers come to them and say, hey, this is what we're looking for, they kind of need to agree to it. Otherwise, they are at risk of losing some business. And so the change that they made is sort of twofold. The one change is that if you're someone who takes out personal loans are going to start counting more negatively against your credit score than they currently do. And I think what this sort of amounts to is credit card companies are worried that people are racking up debt on their credit card, and then they're taking out personal loans to pay off that debt, maybe at a reduced interest rate. And now they owe money on this personal loan, and they still have access to this original line of credit that they had previously maxed out. So personal loans are going to count negatively against your credit score more than they already do. And then the other big change, and this is really the biggest one because I think this will affect pretty much everybody to some degree, either positively or negatively. The other big change is that previously FICO did not look at your debt levels over a long period of time. Okay, meaning that, let's say you owed $50,000 and Chase reported that to the scoring agency. Your credit utilization would shoot up extremely, very high. But then if you paid it off a month later, your utilization would go down just as quickly as it went up. Okay, and there would be no record that you owed that $50,000. Right? Because it was only ever looking for your revolving credit utilization at the last 30 days. But now, and this is sort of related to that example I gave earlier about us both having a 720, but one of us having lost a home. Now, FICO is going to assess how your debt levels have changed over time, specifically over the last 2 years or so. Okay. And so what this means is that if you're someone who is steadily increasing the amount of debt you have, if your revolving credit utilization continues to rise, your score is going to fall even more severely than it already does. And what it also means is that if you have debt for a long period of time and then you pay it all off, today your score would shoot up dramatically. I think with these new changes, your score will increase, but not nearly as quickly as it would have without these changes. All right, so let's say you owed $50,000 in credit card debt. You owed that for, say, a 6-month period or 12 months. Once you pay it off, your score will increase, but your average over the last 2 years is still going to be extremely high, and it's going to continue to stay high until time has had its opportunity to work. Right? Eventually, if you don't continue to accrue large amounts of debt, your score will go back to where you expect it to be, but it's just going to take longer. And that's important in the meantime because you're not going to be able to perhaps get as many credit cards or get the best interest rate in the time after you make all these payments. And so I guess the bottom line as far as for what this means for, credit card and points enthusiasts is that at the end of the day, your credit score is important not because of the credit cards that it can afford you. It's important if you want to use leverage to buy a home or a car or something else that you wouldn't otherwise be able to just afford by paying cash. And so when you're buying the home, your credit score is going to go a long way towards determining what interest rate you get. If your score is not good, you're going to end up paying thousands and thousands of more dollars over the lifetime of that loan than if it were better. And so with these new changes, right, given the fact that your score is going to sort of haunt you or follow you, depending on the lens through which you want to look at it, for a much longer period of time, I think for those who see dramatic swings in their utilization, you're going to want to do a better job of planning, especially if you have big purchases coming up. So, previously my advice has always been, if you're planning on buying a house within the next 2 years, you probably don't want to sign up for any new cards. I still think that is true, but I actually think it's much more important now than it would have been, right? If you're going to buy a house within the next 2 years, we want your credit score to be as high as possible. That means we don't want any hard inquiries. We want our average age to be as high as possible. And now more than ever, we want our revolving credit utilization to be as low as possible. And so let's say you owe $50,000 and your utilization's at 50%, and you're thinking, I'm buying a house in a year. If you don't pay off that $50,000 until the 11th month, right? Like a month before you're getting ready to buy the house, your credit score is not going to budge a whole lot, right? Whereas if you pay it off today, it's going to budge significantly. And so these are just some of the things that you're going to have to be aware of. I think the bottom line, and most of what I've read suggests that if you already have a good score, these changes are going to bring your score even higher. But if you have a bad score, right, if let's say you're below 680, for example, it's going to go lower in the near term. Now, you do have some time to react to these changes, because here's the deal. Banks don't necessarily use the latest FICO score when deciding whether or not to lend you credit, right? Most of what I've read suggests that lenders, banks, are several iterations behind as far as what version of the FICO scoring system that they use. So this new scoring system is called FICO 10T, and I would say it's going to take some number of years before everybody is using this new scoring system. Some folks might use it sooner rather than later. Discover and Capital One come to mind because they're the ones who, it sounds like they're having the most number of issues with people who, they have a 720, but they're not as creditworthy as you would expect someone with a 720 to be. So I would expect for those companies to maybe adopt this new algorithm a little bit sooner. But just, you do have some time. You don't need to freak out immediately, but this is something that you should be aware of. And of course, what's interesting about the whole Discover situation, and this is, sort of a macroeconomic thing that I don't think super well versed in, but it stands to reason that consumer debt levels being at record highs and companies having problems with so many people owing so much money could affect the economy as a whole in a negative way. Obviously, these aren't things that I'm capable or frankly interested in predicting, but it's something that I definitely plan to keep an eye on over the next some number of months, years, etc. So, bottom line for today, if you currently carry a large balance, it would greatly behoove you more than it already does to pay it off as best you can. If you were thinking about taking out a personal loan, think again, right? It's going to hurt your score more than you might think. And then I would just keep an eye on what's happening with the consumer debt stuff. At the end of the day, I would assume that, banks are going to be in sort of a catch-22 situation where they're going to want to tighten their belts as far as offering consumers big sign-up bonuses and things like this. But at the same time, if they turn the spigot completely off, they're going to lose a lot of business. So I still think, generally speaking, it's a good time to be a consumer. It's a good time to be looking at credit cards and signing up for new stuff. But it's definitely going to be interesting to see what happens with all these companies over the next 12, 24 months, thereabouts. That's all for today's episode. This was 19 minutes, so nice. I feel like this was hopefully clear and concise and was something that people will find interesting. I'm always on the lookout for new podcast topics, so be sure to email me or reach out if you haven't already. And with that, that's the end of episode 31. I'll see you guys next week.